You know what's fascinating? While everyone's been watching gold hit record after record, silver just quietly outperformed it by 17 percentage points. And yet, when you look at the actual numbers, when you dig into what's really happening in this market, you realize something extraordinary is unfolding right in front of us. Let me show you something that'll make your jaw drop. Right now, it takes about 75 ounces of silver to buy 1 ounce of gold. 75 to 1. Now here's where it gets interesting. Go back through history, look at any period you want, and you'll find that ratio sitting much, much lower. We're talking 50 to 1, 40 to 1. There have been times when it was 15 to 1. Think about that for a second. The same amount of gold that costs you 75 ounces of silver today would have cost you 15 ounces back then. But here's what nobody's talking about. This isn't just some random number that fluctuates for no reason. This ratio, this relationship between gold and silver, it's telling us a story. And that story is about to get very, very interesting. See, silver isn't just a precious metal. It's not sitting in vaults doing nothing like gold. Silver is working. It's in your phone right now. It's in the solar panels going up on rooftops across the world. It's in every electric vehicle rolling off the assembly line. It's in the 5G infrastructure being built as we speak. And here's the kicker. Once it's used in these applications, it's gone. You're not getting it back. It's not like gold jewelry that gets melted down and recycled. When silver goes into a solar panel, it's done. 30 years from now, when that panel dies, nobody's extracting that silver. It's economically impossible. So we've got this metal that's being consumed at an accelerating rate, and at the same time we've got mine production that's been declining. Not growing, declining. The easy silver has been found. The high-grade deposits have been mined. What's left requires more energy, more capital, more time to extract. And with energy costs where they are, with labor costs climbing, with environmental regulations tightening, it's getting harder and harder to pull silver out of the ground profitably. Now, let me paint you a picture of what's happening right now in the physical market. There's this thing called the COMEX, the Commodities Exchange where silver futures trade. It's where the price of silver gets set, at least the price everyone looks at. But here's what's wild. The amount of silver that actually exists in COMEX warehouses versus the amount of silver that's been promised on paper, those numbers don't match up, not even close. Imagine you're running a parking garage. You've got 100 parking spots. But you've sold 500 parking passes because you figure, hey, not everyone shows up at the same time, right? Works great until one day everyone decides they actually want to park. That's essentially what's happening in the silver market. There are claims on silver, paper promises, that far exceed the actual physical metal available, and people are starting to notice. You're seeing premiums on physical silver, the actual coins and bars you can hold in your hand, trading at significant premiums over the paper price. In some cases, you're paying $3, $4, $5 over spot just to get your hands on physical metal. That spread, that difference, that's telling you something. That's the market screaming that there's not enough physical silver to meet demand. But let's zoom out for a second. Let's talk about what's happening on the macro level, because this is where things get really interesting. You've got central banks around the world that have been buying gold at a pace we haven't seen in decades. They're diversifying away from dollars. They're building reserves. Russia, China, India, Turkey, they're stacking gold like there's no tomorrow. And when central banks move, when institutions that size start shifting their strategy, you better pay attention. Now, they're buying gold, not silver. But here's the thing. As gold rises, as it becomes more expensive, as that ratio stretches further and further, silver becomes the obvious play. It's the poor man's gold, the working man's hedge. When gold hits $3,000, $4,000, $5,000 an ounce, and it will, people are going to look at silver sitting at $30, $40, $50 and think, that's my entry point. That's how I get exposure to precious metals without dropping $5,000 on a single coin. Let me tell you a story. Back in the late 70s, early 80s, we saw something remarkable happen with silver. The Hunt brothers, these Texas oil billionaires, they started accumulating silver, massive amounts of it. They understood something that most people didn't. They saw the inflation coming. They saw the dollar weakening, and they positioned themselves accordingly. At one point, silver went from around $5 an ounce to $50 an ounce in a matter of months. $50. And this was decades ago. Adjust that for inflation, and you're talking about silver that would be worth well over $100 in today's money. Now, I'm not saying we're going to see a Hunt brothers situation again. That was a unique moment in history. But what I am saying is that silver has the capacity for explosive moves. It's a small market. The entire above-ground supply of silver, all the silver that exists in investable form, is worth maybe $50 billion. That's nothing. That's a rounding error for the big institutional players. Apple has more cash on hand than the entire silver market is worth. Think about that. So what happens when even a small percentage of institutional money decides to flow into silver? What happens when pension funds, when sovereign wealth funds, when family offices start allocating just 1 or 2% of their portfolios to physical silver? The market can't absorb that kind of demand. There's not enough metal. Prices would have to rise significantly to balance supply and demand. And we're already seeing the early signs of this. You've got billionaires talking about silver. You've got major investors positioning themselves. You've got countries looking at their strategic reserves and realizing that silver isn't just a monetary metal, it's an industrial necessity. If you want to build out renewable energy, if you want electric vehicles, if you want advanced electronics, you need silver. There's no substitute that works as well. Sure, you can use copper in some applications, you can use aluminum in others, but for high-efficiency electrical conductivity, for the applications that matter, silver is irreplaceable. Here's something else that's not getting enough attention. The solar industry alone is projected to consume massive amounts of silver over the next decade. We're talking about hundreds of millions of ounces annually. And that demand is growing, not shrinking. Every government on the planet is pushing green energy. Every major corporation is committing to carbon neutrality. And all of that requires silver. Lots of it. But the supply isn't keeping up. New mine projects take years to develop. You can't just flip a switch and produce more silver. It takes exploration, permitting, construction, ramp up. We're talking 5 to 10 years from discovery to production. And with silver prices where they've been for the last decade, there hasn't been enough incentive to develop new projects. Mining companies have been focused on gold, on copper, on other metals with better economics. Silver has been the afterthought. So now we're in this situation where demand is accelerating, supply is constrained, and the market is waking up to the reality that silver is fundamentally undervalued. Not by a little bit, by a lot. Let me ask you something. If you're sitting on retirement savings, if you've built up a nest egg over the years, what's your plan for protecting that wealth? Because here's the reality. The dollar is losing purchasing power. It's not a conspiracy theory. It's math. When you print trillions of dollars, when you run massive deficits, when you keep interest rates artificially low for years, the currency weakens. It has to. And that means everything priced in dollars, your savings, your purchasing power, it's eroding. Now, quick aside here, because this is important. If you're sitting on $100,000 or more in retirement accounts, there's a strategy worth knowing about. It's called a gold IRA, and it allows you to hold physical precious metals inside your retirement account without triggering taxes or penalties. I put together a free guide that breaks down exactly how it works, what the rules are, how to set it up properly. It's in the description below. No obligation, just information. Worth checking out if you're thinking about diversifying your retirement savings into hard assets. Anyway, back to silver. Because here's where this gets really interesting. We're not just talking about a good investment. We're talking about a potential wealth transfer. See, throughout history, there have been these moments where assets reprice dramatically, where something that was undervalued suddenly gets recognized for what it's really worth. And early movers, the people who positioned themselves before the crowd figured it out, they do extraordinarily well. Think about real estate in the early 2000s. Think about tech stocks in the 90s. Think about oil in the 70s. There are these windows where the fundamentals are screaming one thing, but the price hasn't caught up yet. And silver right now is in one of those windows. You've got a supply deficit. The world is consuming more silver than it's producing. That deficit is being filled by above-ground stocks, existing inventories. But those inventories are finite. They're being drawn down. And at some point, probably sooner than most people think, the market is going to realize that there's not enough silver to go around. And when that happens, when the scramble begins, prices are going to move fast. I want you to imagine something. Imagine you're a manufacturer. You make solar panels, or electric vehicle components, or medical devices. Silver is a critical input for your product. You need it to operate. Now imagine the price of silver starts rising. Not slowly, but quickly. 10% in a week. 20% in a month. What do? You panic buy. You secure supply at whatever price you can get because if you don't have silver, you can't manufacture your product. You can't fulfill your orders. Your entire business grinds to halt. That's the kind of scenario that creates price spikes. That's how you get from $30 to $60 to $100 in a compressed time frame. It's not a smooth, gradual rise. It's a scramble. It's fear of missing out, fear of not having supply, all hitting at once. And here's the thing. The people who are going to benefit from that move, they're not the ones who wait until silver is making headlines. They're not the ones who buy after it's already doubled. They're the ones who looked at the fundamentals, who understood the setup, who positioned themselves early. Let's talk about what the smart money is doing. Because while retail investors are chasing meme stocks and crypto, there's a different game being played. You've got hedge funds quietly accumulating silver positions. You've got mining companies being bought out at premiums. You've got strategic buyers locking in long-term supply contracts. These aren't dumb people. These are sophisticated investors with teams of analysts, with access to information, with decades of experience, and they're moving into silver. Why? Because they can read a chart. They can see that silver, relative to gold, relative to the stock market, relative to real estate, is historically cheap. They can see the supply-demand dynamics. They can see the industrial demand growth. They can see the monetary demand starting to pick up, and they're positioning accordingly. Now let me show you something else that's fascinating. If you look at silver's price history, you'll notice something interesting. It doesn't move in a straight line. It consolidates for long periods, building energy, and then it explodes. We saw it in the 70s. We saw it in the early 2000s. We saw it in 2011 when silver went from $18 to nearly $50 in a matter of months. And then it crashed, and it's been consolidating ever since. But here's what's different this time. The fundamentals are stronger. The supply situation is tighter. The industrial demand is higher. The monetary environment is more favorable. All the pieces are in place for a move that could dwarf what we saw in 2011. Think about what's changed since then. In 2011, solar panels were a niche product. Electric vehicles barely existed. 5G wasn't even a concept. The industrial demand for silver was a fraction of what it is today. And yet, silver still went to $50. Now imagine what happens when you have exponentially more industrial demand, combined with investment demand, combined with a supply deficit. The math gets very interesting very quickly. Here's another angle to consider. Silver is money. It has been for thousands of years. Before paper currency, before central banks, before any of the modern financial system existed, silver was how people stored value and conducted trade. And that monetary property, that history, it doesn't just disappear. It's embedded in human psychology. When people lose faith in paper currency, when they want something tangible, something real, they turn to gold and silver. And we're starting to see that shift happen. You've got countries like Russia and China actively promoting gold and silver ownership among their citizens. You've got governments stockpiling precious metals. You've got a growing awareness that the financial system, as it's currently structured, might not be as stable as everyone assumes. And when that awareness spreads, when people start looking for alternatives, silver is going to be high on the list. But here's what most people miss. Silver isn't just a hedge against financial instability. It's a bet on the future. It's a bet on technology, on green energy, on electrification. Every major trend in the global economy right now requires silver. The transition to renewable energy? Silver. The shift to electric vehicles? Silver. The build-out of 5G and eventually 6G networks? Silver. Advanced manufacturing, medical technology, water purification, you name it, silver is involved. So you're not just buying a shiny metal. You're buying exposure to the most important technological and economic trends of our time, and you're buying it at a price that doesn't reflect that reality yet. Let me give you some numbers to chew on. Global silver demand is running at over 1 billion ounces annually. Mine supply is around 800 million ounces. That's a 200 million ounce deficit every single year. Now, that deficit is being filled by recycling and existing stocks, but recycling has limits. You can't recycle silver that's been consumed in industrial applications, and existing stocks, they're finite. They're being drawn down. At some point, and we might be closer to that point than anyone realizes, the market is going to have to ration silver through price. That's how markets work. When you have more demand than supply, price rises until demand is destroyed, or new supply is incentivized. And given how critical silver is to so many applications, given how difficult it is to bring new supply online quickly, the price adjustment could be dramatic. Now, I want to talk about something that doesn't get discussed enough: the paper silver market versus the physical silver market. See, most of the silver that trades, most of the volume you see on exchanges, it's not real silver. It's contracts, derivatives, promises to deliver silver at some point in the future. And that's fine. That's how commodity markets work. But there's a problem. The amount of paper silver that exists far exceeds the amount of physical silver available to deliver. It's like a game of musical chairs. As long as everyone's happy trading paper, as long as nobody actually wants to take delivery, the system works. But the moment people start demanding physical metal, the moment they want to convert their paper claims into actual silver they can hold, the system breaks. Because there's not enough silver to satisfy all those claims. And we're starting to see cracks. You're seeing delivery delays. You're seeing premiums on physical metal spike. You're seeing inventories in COMEX warehouses decline. These are warning signs. These are indicators that the paper market and the physical market are starting to diverge. And when that divergence becomes too great, when the market loses confidence in paper claims, that's when things get really interesting. Imagine you're holding a paper contract for silver. You paid $30 an ounce. But when you try to take delivery, you're told there's a 6-month wait. Or you're offered a cash settlement instead. Or you're told the premium for physical delivery is now $10 over spot. What does that tell you? It tells you that the paper price isn't the real price. The real price is whatever you have to pay to get actual metal in your hands. And as more people figure this out, as more investors demand physical delivery, the pressure on the system is going to build. Eventually, something's going to give. Either the paper price is going to rise to reflect the true scarcity of physical metal, or the paper market is going to lose credibility entirely. Either way, people holding physical silver are going to be in a very good position. Let's talk about timing for a second. Because I know what you're thinking. This all sounds great, but when? When is this going to happen? And here's the honest answer. Nobody knows exactly. Markets don't move on a schedule. They move when they're ready. But what I can tell you is that the setup is there. The fundamentals are in place. The catalysts are lining up. You've got inflation that's not going away. You've got central banks that are trapped. They can't raise rates too much without crashing the economy, but they can't keep them too low without destroying the currency. You've got geopolitical tensions rising. You've got supply chains that are fragile. You've got a global economy that's more interconnected and more vulnerable than ever. Any one of these factors could be the spark: a currency crisis, a supply disruption, a major default, a geopolitical event. And when that spark hits, when the market suddenly reprices risk, precious metals are going to move. And silver, because it's smaller, because it's more volatile, because it's been so compressed for so long, it's going to move harder and faster than gold. Here's what I want you to understand. This isn't about getting rich quick. This isn't about gambling. This is about recognizing a fundamental imbalance in the market and positioning yourself accordingly. It's about looking at the data, looking at the trends, looking at what's actually happening beneath the surface, and making an informed decision. Silver is undervalued. Not by a little bit, by a lot. The gold-silver ratio is telling you that. The supply-demand fundamentals are telling you that. The price action relative to other assets is telling you that. The question isn't whether silver is going to reprice higher. The question is whether you're going to be positioned before it does. Because here's the reality. Once silver starts moving, once it breaks out and the momentum builds, it's going to be too late to get in at these prices. You'll be chasing. You'll be buying at higher levels. You'll be competing with everyone else who suddenly figured out what's happening. The opportunity is now, while silver is still quiet, while it's still under the radar, while the majority of investors are focused on other things. Think about the people who bought gold at $300 an ounce. Think about the people who bought Bitcoin at $1,000. Think about the people who bought real estate in 2009. They didn't wait for confirmation. They didn't wait for everyone else to validate their thesis. They looked at the fundamentals. They made a decision, and they acted, and they were rewarded for it. Silver is at that same kind of inflection point right now. The fundamentals are screaming. The technical setup is building. The catalysts are aligning. And the price relative to where it's been and where it's going is still incredibly attractive. So here's what I want you to do. Don't take my word for it. Do your own research. Look at the supply-demand data. Look at the industrial demand trends. Look at the monetary environment. Look at the gold-silver ratio. Look at the price history. Form your own conclusions. But do it now, while you still have time to position yourself, before the crowd figures it out. Because when silver moves, and it will move, it's going to be one of those moments where you either positioned yourself ahead of time or you watched from the sidelines wishing you had. The signal is there. The opportunity is there. The only question is whether you're going to act on it.